Hello, Investing Putts back with you again for an update. It's taken me a few weeks to do one, but sorry about that. So my portfolio is back to outperforming the SPY virtual portfolio. No doubt this is due to the presence of materials, energy, and precious metals in my holdings. These stocks have been up while the SPY has been flat for about 6 weeks now. My portfolio is up about 14% to date. And if I can keep the momentum, I'll be up 34% for the full year. However, this seems unlikely. Correction seems way overdue, and I doubt that I would be immune, though I'm certainly highly hedged against a drop in the SPY. Here's a list of my current holdings, no changes from last week. I was trading spreads on US Steel, but I moved to the poor man's covered call, which I'm running on all my other holdings except for Weight Watchers. I have a poor man's covered put on Weight Watchers, which I put in place after a huge run-up in Weight Watchers after their Q1 earnings. To remind you of how I trade the poor man's covered call, I buy a leap option with at least 4 months until expiration. I aim for a 80 delta leap, which are reasonably cheap. They don't force me to pay too much for extrinsic value. I sell 50 delta covered calls against the leap, and I typically sell covered calls 10 or more days to expiration and buy back the covered call when it drops below 25 delta or rises above 75 delta. So when I sell the 50 delta call, it has maximum extrinsic value. When I buy it back or at 25 or 75 delta, much of that extrinsic value has disappeared, and I have time decay working for me. In this video, I thought I'd show the performance of the poor man's covered call for several underlying shares. This graph is for Cameco, or CCJ, which is a uranium miner. The blue curve shows the performance of the underlying shares, which are up about 20% in 6 weeks. The orange curve is the change in the long call, or the leap, that I purchase when I trade the poor man's covered call. The leap is basically a leveraged version of the underlying shares. This is a little misleading though. In my $28,000 account, I hold about $17,000 in cash, so I'm only using 40% of my buying power. You could go buck wild and use up all your buying power buying these leaps, but I wouldn't recommend it. If we get a 15% correction, the value of your long calls will go not to zero, but a long way towards zero. I'll demonstrate this on Intel in a few minutes. Anyway, CCJ rose pretty steadily. The poor man's covered call essentially kept up with the leap. This is good because the poor man's covered call is a downside hedge. It's good to see that hedge didn't really cost me any upside. The next underline is Dish Network. The stock rose about 25% in a week. The leap went up 75% in that time. My poor man's covered call performance is somewhere between the stock price and the leap, though it's catching up as Dish is trading sideways. This slide is for those of you who want to use up all your buying power. On Intel, which dropped about 25% after the Q1 earnings, the stock price rose rapidly before the earnings call, then dropped equally rapidly after. So the poor man's covered call tracks the leap, which is down about 45% today. So as Intel trades sideways, the poor man's covered call will slowly beat the value of the leap, which is good. The stock price never actually breached the strike price of my leap, and still I was down 50%. So be forewarned, the value of your leap can go to zero or a long way towards zero. Unfortunately for me, the implied volatility of Intel really didn't spike upward during this time. So my leap option didn't get much of a boost in spite of the big drawdown in price. I think this is the most powerful graph of the video. It's for TLT, which is the 20+ year maturity US Treasury ETF. TLT is essentially traded sideways for more than 2 months. Because of time decay, the leap is down about 10%. However, the poor man's covered call is up about 10% as of today. It's pretty impressive to be making 5% a month on the cash invested when the underlying is trading sideways. To summarize, how does the poor man's covered call compare to simply owning a leap? I showed 4 concrete examples for my trading. So if the stock price rises rapidly, as we saw with Dish Network, the poor man's covered call will slightly underperform the leap. If the stock price rises more steadily, as with Cameco, CCJ, the poor man's covered call will basically track the leap. In this case, the poor man's covered call acts as a downside hedge, but it doesn't cost us any upside. So if the stock is flat to mildly declining, the poor man's covered call will greatly outperform the leap. In the case of TLT, the leap was down 10%, while the poor man's covered call was up 10%. So lastly, if the stock drops rapidly, as it did with Intel, the poor man's covered call will perform similar to the leap. So in short, the poor man's covered call can and will drop very rapidly in price. So don't burn up all your buying power trading the poor man's covered call. Hope you enjoyed this video. If you have any stocks you'd like me to talk about or anything you'd like me to talk about, let me know in the comments. If not, I'll see you in the next segment. Bye.